Hello, good morning, good afternoon, everyone. Nathan Sadowski here. Thank you so much for joining us. Today, we're going to cover what happened in the first quarter 2022, which was January 1st to March 31st. Let's jump in. We're going to go over three key areas today. Number one, market review, what happened. Number two, Fed's rising interest rates, as well as inflation in the economy. Number three, some investment considerations. What kind of managed portfolios should we be looking at? It was a challenging first quarter. The war in Ukraine, which is a humanitarian disaster. There are two significant players in the global commodity produce section with Ukraine and Russia. And adding on top of that is, supply chain bottlenecks. It's what's happening all over the world. So surging inflation, rising rates from the Feds led to a lower first quarter. Commodities were the biggest winners. That was fueled by the war in Ukraine, with further inflationary pressures leading to a high surge in oil and grain prices. Managed futures did help gain some traction because they were long commodities. After a strong 2021, U.S. equities did see its first quarterly loss in 2 years. During the quarter at its worst, U.S. equities were down 13%, and an official correction territory, which is defined as a drop in 10%. This is shocking, but this is in line with historic data, through intra-trading declines during the year. Since 1980, despite average intra-trading drops of 14% on average, the year turned out positive 32 out of 42 times. Still batting over 761, not a bad deal. Dividend stocks did remain relatively flat, and they did lead all major equity markets at this time for the last quarter. Value-oriented segments did fare better than the other markets for stocks. So strong dividend companies right now with lots of cash are in favor at this time. Bonds did have their worst quarter in 20 years. Despite higher inflation, TIPS, Treasury inflation protected securities, did fall 3% due to rising rates from the Feds. Longer-term treasuries, which had the greatest sensitivity to the interest rate changes, they were hit hardest and fell a little bit more than 10%. U.S. high-yielding bonds fell about 4.8%, due to the flight stemming from Russia and Ukraine conflict. And lastly, a strong dollar and inflation woes also led international bonds lower for the quarter too. So very challenging quarter for bonds, worst quarter since the 1980s. It's very rare to see both stocks and bonds down for the quarter. Let's put this behind us and in the rearview mirror. Where are we going? The Fed's upgraded rate hike projections, on the extent that rates may, rise this cycle as well here in Q2. What's driven that is the economic outlook and rising inflation. So inflation is getting up there pretty high, and the economy is starting to slow down a little bit. So Fed's made it clear that it plans to raise hikes about 6 more times this year. And this is going to push the federal funds target to about 1.75 to 2% by December 2022. Of course, you don't see that at the local banks on your interest rates or on your mortgage loans. The banks borrow at 1.75 to 2% and then charge you a higher interest rate on there. So the market is bracing for these inflation adjustments right now. So the Fed's expectations for both economic growth and inflation have been moving steadily higher, and they're in tandem since December 2022. But inflation has stuck around. It's been pretty persistent the last few quarters, and the Fed's updated numbers for headline inflation, is running a little bit over 4.3% this year. Certain sectors such as energy or cars is a little bit higher, and this is compared to 2.6 average, which was last December. Economic growth, on the other hand, received a sharp downgrade from 2.8% this year, which was rated at 4% in the last quarter. So that's been dropping here for GDP, not as much spending going on in the economy. Likely and largely, it's a reflection of the Fed's plans to raise rates as well more aggressively this year and consumer spending. Some indicators we look at, this is data provided by the Conference Board. We look at U.S. leading indicators, which is acronym for LEI, has a very long track record since 1959 and incorporated incorporates items such as building permits, homeowners doing remodel or construction of their homes, as well as unemployment claims. They don't just look at home sales or the unemployment rate. While LEI has come off its peak, it appears to be rising at a slower pace, so things are slowing down. And the recent round resembles after what happened in 2009. So this is post 2008, where we had the mortgage crisis, as well as Lehman Brothers going bankrupt as well. In short, economic growth will likely slow. Slowing doesn't mean stalling or reversing, just means slowing down. So peeling back another layer, there is a couple of red flags, otherwise mostly yellow. So levels are generally healthy or fair, with the exception of average consumer expectations for business conditions, so for small businesses. Trends, otherwise, they're looking pretty good. They look impressive. Some key things to watch are the emergence of additional worsening trends. Are things going to get worse, stay the same? So a consistent sea of red, not a good sign. So we want to see more level indicators, what we want to see. As a team on the investment management team, as advisors as well, we're watching this very closely. Consumer confidence really took a hit this last quarter. We all have been to the pumps. We see those rising gas prices, even going grocery shopping at the local grocery market. So grain prices, it's awful as a consumer. So when investors feel gloomy, worried about the outlook, natural tendency is to sell off some risk assets, like your stocks in particular. However, history suggests that trying to time the markets in this way, isn't always a good bet. Consumer sentiment stretches back over 50 years, and with 8 distinct peaks and troughs noted, so a peak and then a trough being on the bottom, we also show how much the S&P went up or down in the 12 months following these peaks or troughs. So we have the data on there. On average, buying at a confidence peak, buying up in the high yielded you 4.4, while buying in the low yielded you return at 24.5%. We probably want to be buying on the bottom. We go shopping for clothing, we want to buy it at a discount. So it's not to argue that stocks are going to return anything like 24.5% this year, but many other factors are going to determine what happens between now and the end of the year. However, it does suggest that planning for 2022 and beyond, we should be focused on long-term goals. We're also looking at valuations with companies, when to buy and sell, but how the rest of people feel the world is a different story. Right now, value stocks tend to be better in these time periods right now, and it's a good entry point for other types of equities and stocks. While there's plenty of ups and downs in the stock market right now, returns are tied to corporate earnings and economic growth. So since 1945, over 77 years, S&P has gone up exactly as fast as the price earnings index. So it's data that's been shown there. And it shows right around 7.3% per year. And of course, those of us with those dividend paying stocks are going to get some extra dividends on there as well, which is nice, added on top of that 7.3. So despite the fact that there were 12 recessions over the last 77 years up to today, fewer than half of them show up on the radar as just basically ripples. So right now it's not the best time. It is a little gloomy, but to sum it up, we're going to weather this storm. We're going to reach your long-term goals. As long as the economy keeps growing, we're going to be okay. So don't sit in the sidelines when the market has been beaten up and been shocked. Typically, when there's large downside swings, those are followed by large upside swings. Stay invested. Looking forward to those higher peaks. Thanks for watching.